In this video, we're going to look at a error in inventory and how to make the adjustment for it. So make sure that you watched the playlist of videos for errors in inventory, just so you have a basis in this. And it's the last video on the Chapter 9 playlist. Um, that'll give you a little bit of background of how, different types of inventory errors and how they affect the inventory system, how errors can contaminate other pieces of the system, because ultimately what we're talking about with inventory errors are accounts payable, potentially, the inventory account itself, ending in inventory, and also cost of goods sold. So let's look at this problem. This one has 2 years, and so it has the potential for there to be errors carried over into the next period, which I think is something, a natural extension of inventory error analysis. And we got Avery Brew House, and they are looking at their 20 in 20x4. They're looking at some errors from the prior 2 years, 20x3 and 20x2. We're going to assume that they use a periodic inventory methodology. Right. So in 20x2, they fail to include in transit FOB shipping point inventory. They ordered the inventory, it was valued at $50,000 in its ending inventory account. Right. It was included in the purchases account for 20x2, and the goods are going to arrive in 20x3. So in 20x2, this was in transit FOB shipping point inventory. Should it be ours? Should Avery record this inventory as part of theirs? Do they have title? They do have title, because if it's shipping point, that means that title shifted, title became Avery's when shipped. I mean, I was trying to think of another way to say it, but the shipping point means when it's shipped, it's changed ownership. So it is now Avery's goods while in transit. So they have failed to include it in their inventory count. They should have. So this was a mistake. Should have included in inventory. It did include it as a purchase for 20x2. So it did record the purchase, it just didn't count it as there because it was on the road, right? And this part, the inclusion in purchases, is definitely correct because the title became Avery's when it was shipped. So that's when we record the purchase. But we should have also included it in our ending inventory. So that was the mistake. It looks like the only mistake that happened in 20x2. In 20x3, they included inventory valued at 30,000 that had been consigned to Avery, to it, for sale in the Indeed. Uh, excuse me. Sorry. Oh, listen. All right. I knew it was coming. Sorry, that's why I all of a sudden was speechless. Avery included some inventory at 30,000. This was consigned to it, but it included it in its ending inventory account. So Avery's the agent in this transaction. This is not Avery's inventory. It should not have been included in the ending inventory count. So this is should have excluded. It overstated its ending inventory because it included that. And in 20x3, Avery included a purchase of $70,000 in inventory that is in transit FOB destination. So it's hasn't arrived, it's still in transit between seller and buyer, and it won't exchange title until it reaches the buyer. So this should not be recorded as a purchase until it arrives. So until the arrival, we don't record it as a purchase. So this overstated my purchases, should not have happened. All right, so how do we incorporate these into a framework to determine how the error potentially contaminated other issues? In 20x2, versus 20x3. I'm going to keep track of 2 years in this analysis. Usually we're just looking at one in the notes, but we do it by looking at, what's the error in my beginning inventory for these 2 years? Then we assess net purchases for any error in those 2 years, right? We add those together to get GAFs, which will tell me the error that one or both of these put into GAFs. We subtract ending inventory under a periodic system. And remember, that's what we calculate first to find cost of goods sold. So it's just simply the inventory equation. Now, beginning inventory does not have an error unless it carried forward from the prior period. We have no information about 20x1, so we have no ability to determine whether there's an error in that. So that's just not there. Purchases for 20x2. Let's look. We included the purchases account, which was appropriate, but we forgot to include it in our ending inventory count. So the error wasn't in purchases, which means that there's no error here in gas because beginning inventory and purchases didn't have an error. Now, we did have an issue with our ending inventory because we failed to include the $50,000 of inventory that was shipped FOB shipping in transit at the end of the period. So if we did not include it, we committed an error and understated our inventory by $50,000. Now, if I take GAFs that has no error and subtract something that's understated, right? Because I'm subtracting something less than it should have been. I'm actually going to overstate my cost of goods sold by that amount. So basically, subtracting an error reverses its direction, just like subtracting a negative number. Right? All right, beginning inventory. Now, normally we would say, hey, beginning inventory, no error, but we set the dollar value of ending inventory at an understated amount of 50,000. That's going to be the inventory we begin our 20x3 year with. And now we look to see, did we have any issues with purchases during 20x3? So it looks like this consignment issue was ending inventory issue, but this purchase, they included a purchase when it was FOB destination. That should not have happened. So we actually overstated our purchases by 70,000. And just as a kind of a reminder from the notes, remember when we're thinking of that overstatement of purchases, it affects two things. It affects my purchases account under a perpetual system, and it affects accounts payable, a liability, because we're purchasing on credit. So this in total will lead to an overstatement of $120,000 in gas because this was overstated, that was overstated, they combined. Oh, they weren't both overstated. Man, I gotta check my work a little more carefully. This was understated. Understated. COGS was overstated. And so that's not 120,000. That's an understatement of 50 plus an overstatement of 70 leads to an overstatement of 20,000. Right. Now we have our ending inventory. And was there a problem with that in 20x3? There was. We included some inventory that had been consigned to us, the 30,000, but it should not have been, included. Now remember, when we're doing our periodic inventory system, this is pretty important, right? Remember that under a periodic system, and this is just periodic, whatever I have in beginning inventory, in this case, an understated $50,000 amount, is totally separate from how I mess up ending inventory, except for its effect on cost of goods sold, because because when we credit this, we're just going to credit it out. And then we're going to debit ending inventory at the amount we count, which in this case included that 30,000. It should have excluded that. So it overstated the ending inventory by 30,000. And then we make an adjustment with our cost of goods sold periodic entry. All of that to describe why I don't net off this $50,000 error against the $30,000 error. Now I'm going to subtract this ending inventory. So that means it reverses the direction of the error, and it's actually acting as an understatement when I combine these two. If something is overstated by 20,000 and then we subtract something that is overstated by 30,000, we're going to end up with an overall understatement of $10,000 to my cost of goods sold account. Okay. So those are the effects for those 2 years. How does this affect 20x2? We're looking at net income, we're looking at assets, liabilities, and equity. All right, so is there a net income effect? There is a cost of goods sold effect. And if we overstate my cost of goods sold, we're going to end up understating my net income because we're subtracting too much cost of goods sold. The assets you can take directly because we are recording an understated amount of assets here, also by 50,000. Are there any liability issues? And I mentioned this because liabilities are often attached to the purchases when we're making on credit. In this case, in 20x2, we didn't have an issue with our liabilities, no error. In our equity, though, when we close to retained earnings, this income, it will understate my equity account by 50,000. Right, so this is the 20x2 analysis of the errors. An understatement in my net income, an understatement in my assets, and an understatement in my equity account. For 20x3, perform the same analysis using this here. Net income, we have understated COGS. Well, if we subtract an amount that's too low, then our net income will actually increase. So that's an overstatement there. How about my assets? We have a $30,000 overstatement of my assets. The liabilities are overstated by 70,000 because of this issue. And then net income closes into my equity account and is overstated 10,000. And then we just have to account for one more piece. This error caused a $10,000 overstatement through retained earnings, right? But retained earnings began at an understated amount. So the beginning balance of retained earnings was understated by 50,000. And then we closed net income into it. And we closed an overstated net income amount to it. And it is income, so it will credit, but it's crediting a little too much, right? Basically now still overstated by 40,000. Or I'm sorry, not overstated, but understated, still understated by 40,000 because there's $50,000 of an understatement and $10,000 of an overstatement. That would net to an understatement of 40,000. So the overall understatement, when everything is done and I add in this prior understatement, is understated by 40,000. And If you didn't remember to include that effect, the way that you should or could think about it is that prior to this, if we look at the direction of our errors in A, L, and E, A equals L plus E, if something is overstated by 30K, that has to equal the error in the overstatement understatement. And if we stopped at the first part, those are O's, not zeros, right? This doesn't work, right? This would be overstatement of 30 equals overstatement of 80. But if we look at it when adding this information, this understatement in retained earnings that was our starting point, and then a reversal of just 10,000 of it to get to an understated amount of 40,000, then this balances. We have an overstatement of 30,000, and then when we combine these two, an overstatement of 30,000. The final piece asks for an adjustment if the account discovers those errors. And if we discover the errors, really what the adjustment should look like is something along the following. I'm going to just pretend actually it makes it easier for us to assume that the account founded in 20x4 when all this had been closed into the system, because otherwise we have to do a couple of things. So let's just say 20x4. And what is our problem at the end of 20x4? Well, we have assets that are overstated, we have liabilities that are overstated, and we have equity that is now currently understated. So in order to get the assets appropriate, if they're overstated, we're going to have to credit them by that amount to reduce it. And our asset we're talking about is the inventory account. If liabilities are overstated, then we're going to have to debit the account that's problematic there. And that would be our account payable account. And then what's going on here? What account is this? This is the retained earnings account. It's understated by 40,000. And then so to get it to its appropriate balance, we're going to have to add some to that amount. And we're going to add 40,000. Right? This ignores taxes because then you would have to have a different sort of entry. And again, the errors were found in 20x4 after closing 20x3. That simplifies it greatly. Okay, so this is a very good comprehensive example of errors, and I hope you learned some from it.